Welcome to TheoTrade. This is Don Kaufman. It's June 12th, 2019, and you are watching the TheoTrade evening video. Allow us to begin this evening. We've got about 14 minutes left to the cash close. We're going to take a look specifically here at the SPX. Why? Because the SPX expected move, well, it matters right now. And, well, it really matters. The fact that we're coming to the cash close on Wednesday. We've got nothing but Thursday and Friday left this week. And people, we got a whole lot of room to run to the upside and the downside. One of the things that I want to point out is this central line over here on the expected move. All right, that's effectively where the week started. Where are we right now? Well, we're effectively where the week started. I mean, the S&Ps, what have they done thus far? Absolutely nothing. They bid up. We've actually rolled over quite considerably. But I just want to give you a feel for the upside to the downside. You might laugh, you might cry, but I'm telling you, the next 2 days, expect quite the degree, okay, of volatility. Now, again, all I'm trying to do over here is just give you a little zoomed in feel, again, a zoomed in feel of what we can actually expect in the next 2 days of trade. To the downside, you're looking right around 28.26. To the upside, 29.20. We haven't even gotten close to or touched the edges of the expected move. Now, of course, in the previous 2 trading weeks, obviously we had a massive breach of expected move last week. The week before that, also seeing a fairly substantial breach of expected move. We fully anticipate that we're going to rock one way or the other here. And again, it's a kind of a binary event, right? See, the thing that you have to recognize about the expected move is it's not pertaining to directional bias. Like, there's no directional bias in this expected move. All I can tell you from looking at this is like, all right, we haven't touched the upper edge, we haven't touched the lower edge, and from a probability standpoint, in almost every single week, we do touch the edge, right? Okay, or get very, very close to it. And that's not always going to be foolproof, but it's, again, it's a high probability we touch or get very close to one of the edges of those. So we anticipate that to occur in the next 2 trading sessions. Lots of room to run. Now, with that being said, a moment ago I mentioned that there's no bias to this. But let me give you some bias. Let me actually add a little bias from the marketplace as a whole. A few things to me really stand out today. All right, let's start with one of my favorites, the financials. The financials today, they're off by the tune of about 1%. What gives? I mean, I haven't seen the financials off 1%. The S&Ps, what? They just keep staring at it, laughing. They're only down 0.3%. On top of the financials, let's compound some of the risk. Here's the monsters of tech. The monsters of tech are off, again, about 0.6%. What gives? Again, the S&Ps are only down 8 points. You've actually got what? Arguably your 2 largest sectors here that are off considerably, right? The S&Ps just keep staring and right on laughing. Then you want to come down, you want to take a look at the energy sector. The energy sector is getting rocked by over what? 1.6%. And again, the S&Ps are extraordinarily resilient in the face of this. What's going on? What is bidding up this market? For that, you have to come right here. This is S&P 500 sectors. I'm going to go ahead and close up this left side bar. Now, as I drag my mouse down here on kind of the right-hand side of the screen, you'll actually see which sectors. People, it's utilities. Utilities, okay, is bid. Now, this is a relatively small sector, but utilities plus real estate, okay, plus like healthcare sector. We're getting like a sector rotation in here, and it looks extraordinarily defensive. Why is utilities bid up? That's usually used duck and cover. Real estate sector, also kind of a duck and cover. Healthcare hasn't done all that much lately. Again, kind of thought of as much more defensive in nature. Your big sectors, they're not bleeding out today, but they're most definitively down. They're being rotated out of after, again, this kind of blistering rally. Does that portend that we're going to see some sell-side activity in the days to come? I'll tell you what. Okay, I would believe the financials alone. This looks like the financials have effectively turned. Both yesterday and today, there's been some sell-side activity in those financials. Okay, and that alone is enough for me to kind of gauge like, all right, looks like this rally is starting to cool off to a degree. So taking a look at that, we're also, of course, taking a look a little bit at the bond market, one of the points I've been making day in and day out is the bond market, it refuses to back off. Even in the face of the fact that the S&Ps have exploded. I mean, exploded to the upside. Let's just quantify this down below over here. That's the 2731 gravity point. Up above here, okay, that's the 2911 gravity point. And I got to tell you, the gravity points have been just uncanny. Uncanny how effective these things have actually worked out. Oh, I'm sorry, we touched through by what? A half a point over here. The actual high was 2911 3 days ago. Nevertheless, we kind of feel like we have and are starting to roll over. All right. So as I was saying, during this kind of, wicked rally to the upsides, what we term the rip your face off rally, those bonds refuse to kind of back off. That tells me there's still, again, quite the degree of risk out there. Now, we all realize we're in just a Twitter happy, news-driven marketplace. Nevertheless, all things being equal, I like some of the sell side right here. I think we may actually fade a little bit as this week progresses. I am not going to go as far to say that this is going to be some wild sell side activity because there's nothing on the screen to dictate that. But I am going to say it looks like, again, we're rolling over quite nicely given the fact that financials are down. Compound that again with the fact the monsters of tech. We love what's going on inside of energy. We love it because, we've talked about short positions in oil. I mean, oil to me tells a completely different story than, of course, the S&P 500 does. And oil to me, this is kind of using it a little bit as a mainstay in the marketplace. Why is oil down? Probably because global growth is slowing. All right, we've heard news out of OPEC, and it's not driving the price of oil back up. This definitively looks like they're pricing in a global slowdown. So, in a market of absolute chaos, right? And the chaos comes from the fact that a global slowdown, okay, is causing the Fed and all the central banks to pump liquidity. That takes interest rates down. Taking interest rates down is being thought of as a good thing for the S&P 500. So the S&P 500 goes up on bad news. But, okay, oil, how does it fit into the mix? Oil, it sees the truth. It's a commodity product. It says, no. We really are going to slow down. It's only a matter of time. Okay, it really is only a matter of time before the S&Ps start to turn and also see some sell-side activity. Hey, listen, any way you want to cut it, eventually you have to factor in if there's a global slowdown, these companies are not going to make as much. The Fed can be there all they want, but eventually this marketplace does turn its back on the Fed. Now, a lot of positions that we've been in, a lot of positions we've been discussing the last couple of days. XLP, right here, right now. Listen, if you're not in this position, this is a short position, okay? If you're not in it, we may have actually seen, again, a turning point today. The XLP, which is consumer staples, does finally look like it's going to make this turn. Now, inside of the XLP, we've put duration positions on in here. We've actually thrown at this thing some in-out spreads, a lot of different trades inside of the XLP. Next one on the docket. This is one I actually mentioned live in chat. Again, live in chat. We opened up a Cisco position literally yesterday. It's already closed today for over a 30% profit. Okay, another one that's on the docket. Emerging markets, the EEM. EEM, we did the exact same thing that we did inside of Cisco. Underlying has been bid up. The ETF has been bid up substantially. We actually stepped in with a bearish in-out spread. We have not closed this yet, but it's right on the dance floor. It's up about 20%. Okay, the rule is defined. We close these things for a 30% return in the first 3 days of the trade. Nevertheless, a whole lot of opportunities starting to appear in today's marketplace. Again, a whole lot of opportunities are appearing in today's marketplace. If, again, this is the end of the rally, just a little bit of sell-side activity, that's all you need to make these in-out spreads work. Last but not least, let's pull up, of course, none other than the utility sector, which utilities, really, it happens to be the end-all, be-all. We'll look for opportunities in here in the days to come. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.